And in the mining sector, I mean, with the valuations that we're looking at now, it seems that the obsession has gone and the reality has not arrived. So with this panel, this is an essential panel for all mining events because it's a value investor panel. And the other conveners of mining events don't do it, either because they can't get the people on the panel or they don't have the audience for it anymore. But the important thing about Mining Journal and Mining Journal research is that the investments are made, so we should share the overview of both the macro, the legal, and the assessment of the projects. But I can save you a subscription here by introducing the first speaker, Tom Albanese, who really for many years, I call him a mining nerd, but I mean at a very, very high level, he is one of the best analysts I've ever come across, but I can't afford him, so we have to talk from time to time. But Tom, from a value investor's perspective, where is the value in the
Yeah, so I want to really comment on two spheres of that quickly. The first is that my view is the entire sector is undervalued. And that is based upon a very simple premise that carbon is a problem, electrification is a necessity. If you believe that carbon is a problem and electrification is a necessity, then the market will come to us. So I think that that's going to be the tide that lifts all boats. And I think that there's a value throughout the sector for that, absent some that you have to sort of be aware of. But then importantly, you got to look at, okay, the tide will lift some boats more than others. Which are the boats that are going to be lifted up more than others? And in many ways, the thematics came out during the presentations today. I think that particularly because of the inflation, price of gold rising, higher discount rates, all of those macro factors, investors have less confidence that a project that starts getting built today will be built on budget or on time. It's hard to get drillers. It's hard to get miners. It's hard to get that pallet of steel or wood or whatever else you need. Because supply chain disruptions are still there. You can't predict inflation. Is it going to be 6% or is it going to be 12% next year? So CapEx is basically a greater variable than it would be in the past. So for me, that means there's a delta right now, a value delta between projects that are already built that have they're valued accordingly versus projects that still need to be built or they're being built, that there's an element of risk associated with them, so they're being undervalued. And we saw that in presentations of great discoveries, great opportunities, but again, they were all saying our valuations are very low, and they were really, really low because of that. So I think that in terms of relative values, those undeveloped projects or those projects that are being developed now have more room to lift as all the boats are rising. The second part I'd like to talk about is jurisdictional risk. And in my view, because of the geopolitical tensions, because of a lot of other things going on in the world, my view is that the risk delta between, say, OECD countries and the rest of the world is too narrow, and it doesn't actually reflect what's going on in terms of the risks of those projects. And as a consequence for that, I think that, if anything, assuming projects can get permitted in an OECD convention, if anything, OECD-located projects are undervalued compared to projects in riskier jurisdictions. So again, where am I putting my investment book in? North American projects that are sort of in development right now, or they're halfway built right now. For me, those are the ones that have more leverage to the upside when at the same time all the boats get lifted.
Yeah, but Tom, if you put those two things together, the first point you're making is the critical need for metals. Otherwise, we can't deliver the clean energy transition. But it's much broader than that. It's the underinvestment by the mining majors in replacing their reserves.
But it's for the same reason. It's for the same reason. It's that the investors are saying, we want the money back, and we're not going to give it to you. So whether it's a venture investor thinking about a financing a discovery, or it's the Rios or the BHPs, what's the size of their capital budget. In both cases, investors are saying, we want our money back, and we're not yet ready to give you basically free reign of your balance sheet. That'll change. That has to change for us to solve this conundrum that we're in. But right now, and I would say that's added on top of that is the ESG agenda. And I'll make some remarks at the end of the day about this, because there is a basic ESG contradiction out there. On one hand, ESG agenda does not want mines to be built, does not want really anything to be built. So they say, stay away from the miners, stay away from the oil companies. On the other hand, the single biggest problem the ESG agenda has is climate change. And they're almost sort of wishing that that goes away, that there'll be enough recycling, there'll be enough thrifting, enough substitution, but it won't. So at some point in time, that contradiction has to get itself solved too.
Well, you've given a pretty clear indication of how it's going to get solved. If you're saying, as a key mining executive, that the whole sector is undervalued in the development projects and that investors are not picking up the opportunity because they want their money tomorrow, the opportunity is open for Martino.
Yeah, and by the way,
For Martino,
the mining companies are not as investable as the Silicon Valley Bank, because it's just not as woke. It's just not as fashionable. Is that the right investment decision? Those that have invested in the Silicon Valley Bank had made the wrong investment decision. Hopefully they'll start investing in mining and make the right investment decision.
Perhaps just to add on top of that with some stats, the average portfolio manager has less than 0.5% of his portfolio allocated to gold and gold equities. If you were to add up all the gold companies in the sector, this would not even crack the top 35th ranking in terms of market cap. So we need this sector to be a lot more relevant to be able to attract generalist funds that we talk about. And this sector, the irony of it is it's never been healthier than it is today. Balance sheets are strong. Companies are talking about free cash flow yields, which is something we never talked about 10 years ago. Gold price went to 2,000 last year. I didn't see any company greenlight marginal projects like was done 10 years ago. Companies are making discoveries and are putting them on time, in construction on time and on budget. So what this means is that as soon as a little bit of interest goes into the space, the money that can flow into it can materially lift the sector valuations.
But I think it's obvious that mining companies with significant cash reserves, and the big mining companies are basically profitable at the moment. I don't understand why they are not getting off the chair and doing something about it. And it would seem to me that Endeavour Mining is a company that in Africa could make a very material difference, but you got to spend the money. At what stage? I'm sorry, I'm not looking for guidance. I'm just saying, at what stage does it become?
Well, I think going back to the comments that I thought were great that Tom made, investors want to see their money back. And if you're in riskier jurisdictions, they want to see that money back much quicker. So at Endeavour, we've been able to commission 2 mines in the last 5 years that had paybacks of less than 2 years.
Yes.
IRRs of over 20% at 1,300 gold price. And over the last decade, over 10 years, we met guidance every year on both production and costs. So these are examples, Endeavour now is a case study of a company that can operate well in West Africa. And we're not alone, especially during the COVID phase and inflationary phases. We've seen many companies in West Africa continue to meet their production guidance and cost guidance, and that hasn't been the case in other parts of the world. So now it starts to be a question of how do you appraise risk? On one hand, in developed countries, you have perhaps good projects, but getting a permit might take you a decade. Whereas in West Africa, we're able to go from discovery to production, including the permitting phase, in less than 7 years. So nowhere else in the world can you achieve this.
Well, you can. All you got to do is take over a company that's already developed it all and has not got a valuation.
Yes, I agree. But take Endeavour, for example. The mine that we're building now in Ivory Coast called Lafigué, we discovered this. It's 3 million ounces. We spent less than $20 million to discover this. Today, it's a project that can produce for over 10 years at $200 200,000 ounces per year at less than $900 per ounce. Next case, we discovered a new greenfields project in Ivory Coast last year called Tanda Iguala. We spent less than $12 million and found 3 million ounces within a 15-month drilling campaign. So from 0 to 3 million in 15 months. If you're able to continuously do this, and the geology in West Africa with a good team allows you to do this, there's no need to go and, like other companies that paid over $1 billion for a 3 to 4 million ounce project in remote part of, certain developed countries.
Well, they weren't disciplined in their approach. But from a value investor point of view, I think it's time to turn to John Clarke, because John's a generation ahead of Martino, and he discovered the projects that other people have been acquiring. So, John, from a fanatical geologist point of view, the value in Africa from projects, where is it? What jurisdictions?
I'm forever getting annoyed at meetings where somebody said, oh, we did that in Tanzania. Well, you're not working in Tanzania. What's the law of the land where you are? And if I go back to days of looking for exploration portfolios, a critical thing for me is, do the politicians actually obey their own laws? And you'd be surprised that some of the smaller, less known, maybe single-party states actually obey their own laws to the letter of the law. And for me, that's a place to go and look for business. If the geology is right, and the geologists who've worked for me in the past say, yeah, this matches all of our criteria, then I can see that I'm not wasting my company or their shareholders' wealth by going out and looking for projects there. Hence Nevson Resources going to Eritrea, single-party state. They never once broke their own law. They never once lied to me in private or in public. That's what I want out of business relationships with governments. But I keep coming across people who think they can bend those, and they're not the politicians usually. It's actually people in business.
But from a point of view of projects, what you've done all your life, you've gone in there early, you've identified a jurisdiction, you've established the relationships, and then a large company comes in and develops it.
Yeah, and
you take example of Ghana.
Yeah, and Ghana was a pretty interesting one for me, because in Ghana, I actually worked for Ashanti Goldfields as a generalist, but my job was to set up an Africa-wide exploration portfolio for them, build up the portfolio using the best mines that we already had in the company. And then once set up, we'd go and find a real specialist who could then manage it properly. My job was to build a portfolio, get out there, use our best mines, and also look for properties that we could buy. So we went out for greenfield, same as I've done with other stuff since. And yes, you're looking for somewhere where usually somebody has mined before, might have been 200 years ago. I've just been switched off. Hello, and I've lost my thread. But what can also happen in a mining company's life is it's searching out for a portfolio, and while it's looking at it, it comes across opportunities that you just can't ignore. Not just exploration, but something that's an advanced state, in which you, as a company that can raise funds, can go and build that the current owners can't. And for that, you're actually willing to pay a premium. What is the premium? Unfortunately, in the current market, if it's a listed property, the premium is something like 28%. If it's a private company, there's no limit on the premium that can be paid for it. I think that's a hindrance, to be quite honest, because some things are so undervalued that to pay 28% more is still undervaluing on both parties. So there's a bit of a conundrum there. That's not quite what you asked me about, but you're looking for quality. We found three properties that somebody else already had that could get into production. And in those cases, we bought them, we built them. The end effect of that in the business cycle is actually the exploration guys had to drop properties, because you can't run all the properties that you had before you became a mine builder. And you've got to be willing to be quite critical over value, politics, finance. ESG, before I get shut up, one thing about ESG, we've all done it. I don't know how you can run a business without being focused on an ESG. It's part of the bedrock of being accepted in any place you want to do business. If I go to do business anywhere other than Wales, I'm a foreigner. So I have to recognize, as a foreigner, being a guest worker, I'd better conform, I'd better look after local issues and be part of them. But the great news for me that ESG has so much focus now, it's not good enough to just do it. It's really important to talk about it, tell the world what we're doing. Historically, people like me have done it and not told anybody. And I like the fact that the young guys in the business, they can actually capitalize on this and they can say, we do this, we have done it, we will do it in the future, and all kudos to them.
Yeah, John, I think that's enough of a speech on ESG, but the critical thing really where John's coming from, it's not the jurisdiction risk, it's the establishment of the relationships in jurisdictions which can deliver. And John Clarke, look him up in Wikipedia. And his latest venture is Eritrea, where he's about 10 years ahead of the majors. Now, on this panel, there's two distinguished panelists that haven't spoken yet. Christopher Ecclestone, strategist for Hallgarten Research and controversial entity, has agreed to give 5 or 6 minutes maximum on the things that the other investors forget to look for, the ill-considered trifles of value investment.
They're not trifles. My enthusiasm at the moment is for the weird and the wonderful. As people know, I'm a fan of offbeat metals and things like that. But I look at the whole universe of stocks, metals that are, and minerals that are out there, and I see interesting things happening in big metals. For me, one of the most exciting things potentially is the spin-off of Vale's nickel assets to recreate something like the Inco of days gone by, because the global market has been crying out for a nickel champion, and that nickel champion disappeared over 10 years ago, and nickel has been lost in the wilderness since then, not as a metal, but as having a company that you could get a direct exposure to major products with a competent management, which I don't believe that Vale have provided, and seeing that in the public sphere is potentially a great thing, and I think that'll be the South 32 of the next 10 years.
Well, Canada
if that gets spun out.
Nickel is in the room, and that's the most leveraged one to nickel development projects that was listed.
Yeah, but we've got existing production at Vale's nickel asset, and potentially, they might be an acquirer of Canada Nickel. But you need to have a big beast in the nickel space, and we haven't had that, and potentially we are. But, going off-piste, I'm an enormous fan of Argentina, as people know. And we heard Alex Zuckernick this morning come out and say that he thought that Salta and San Juan were the best jurisdictions in the Americas. Love that comment because I would agree with that. Another area that people have not been looking at for more than 10 years after there was a lot of burnt fingers is the stands. The stands have fallen off the radar, and I think the stands are ready for rehabilitation. And not enough people are looking at those areas, and they should not be left to be the happy hunting ground of the Chinese. And then you've got, little countries, as John said here, Rwanda. It's like an excellent place. I mean, great geology in a very accessible location with a regime that is mining friendly. And you can hunt around in the OECD, as was mentioned before, for good jurisdictions, and many of them just aren't. They're not helpful. They're putting stones in the road, and yet some of these OECD jurisdictions don't have the metals that you want. If we're talking about tin, the US virtually has no tin. Canada has hardly got any tin. And yet you go to Africa and you can find countries there like Rwanda that have great tin resources. And if you want tin, you're going to have to go to Rwanda. You're going to have to go to Bolivia. You have to deal with it. And it's not good enough to just sort of like dismiss Evo Morales. Evo Morales is gone. You need to work with the new regime there as much as one can. But one should not discount metals, minerals, or the jurisdictions that may not be on at the top of the Fraser Institute rankings, because companies that are down the Fraser Institute rankings rise, and the ones that are at the top go down. And we've seen that over the decades, and it will continue to happen.
Yeah, but Christopher, I've got one. What's inevitable is that the major companies are going to have to go to jurisdictions they didn't want to go to because they've got agreements to supply metals. And what happens if you have to say to ThyssenKrupp when they ask you, well, we've only got another 3 or 4 years left. ThyssenKrupp want 10 and 20-year supply agreements. So I'm afraid that the mining companies are going to be obliged to follow the value investors in their lifetime so that we will actually make money out of some of these investments. But speaking about making money, Dominic, you have a lot of subscribers that are following on your every word. And what do you see from the value investment point of view? Where do you think the value is in the resource sector, not in entertainment?
Well, I do have a lot of subscribers to my newsletter, and a lot of them are very frustrated. And it's because I've unearthed what I considered to be a couple of good value mining plays, and what were good value mining plays are now extremely good value mining plays because they're 20 or 30% lower than they were a year ago. And so, you know, value keeps on getting more valuable. And the problem that a lot of people have, and I think a problem that mining itself has, is the fact that a lot of investors it's all very well saying people are impatient, they want to double their money by tomorrow, but that kind of thing does happen in you know, cryptocurrencies or whatever. But in mining, you know, you take the long view, but a lot of people, they look at what they bought a year ago and it's 30% down a year later. You know, how do they have to go? Is it going to go down another 30% next year, or do they take the tax loss? And you know, people are more forgiving, and they understand that, you know, the broader metals often drive the price of mining companies, but you know, bear markets drive away investors, and we're in a bear market, and it just seems to get worse and worse and worse. And so I don't know what the solution is, because the narrative will change, and then suddenly everyone will want a mining company, and some of these junior companies will double or triple in a matter of months. But how long do we have to wait for that to happen? And coming back to your point, Tom, your very first point that you made, I'm a big believer in narratives, and stories drive investment. And the story that you described of, if we want to realise this green carbon-free future, then we're going to need to mine about 3 times as much metal as we currently mine. I think an electric vehicle has 4 times as much metal in it as a normal car, something like that.
Copper.
And copper, tin, lithium, all these things. And yet, now that story is you know, I heard Nigel Farage articulating that very same story the other day. It's a well-told story, and yet metals prices continue to sort of flatline and decline slightly, and the mining companies underperform the metals. So either that story is false and net zero is never going to happen, but that story has been told, it's out there, and yet the metals prices haven't reacted. So I don't know what needs to happen to change narrative. I wonder if there's going to be some, you know, I'm terribly excited about all these developments in AI, artificial intelligence, that are going on. And, you know, I've just been talking to people upstairs. We got ChatGPT to write a mining report. We got ChatGPT to write a job description. I got ChatGPT to write a letter of condolence to somebody. You can use it, and it's going to be incredibly disruptive to the workforce. But the bottom line is you can get ChatGPT to analyze mining data, perhaps, or artificial intelligence. You can't get ChatGPT to build you a mine. And we are in this world where all the value is digital, and anything analog is not just a burden, it's a liability. And until something changes and suddenly people actually go, we need real stuff, we've got problems.
Well, it's pretty obvious what's going to happen is that when the majors cannot develop the next phase of a mine when it's 70 years old or something, they got to buy something that's 3/4 developed.
How long do we have to wait, though?
Well, I've been waiting about 10 years and one of them.
If I may go back 25 years, because if those of the room that remember, in the mid 90s, we were going through a bit of a Asian-led investment cycle boom, the tiger economies, and then that ended with basically the Asian crisis in about 97, 98. And as a consequence of that, the industry got very conservative between 98 and about 2004, 2005. Even though in the early 2000s, there was all this evidence that China was going to be coming to the fore. I mean, so you heard the stories, China's coming, but I think the industry saw this was a repeat of the Asian crisis. It's investment led. It's not going to have legs on it. So the industry did not invest until basically we had a demand shock, which was about 2006, 2005 through 2007. All of a sudden, demand's picked up. There wasn't any mines there. Basically, the capital hadn't been put in, so it led to basically an investment boom from about 2007 onwards from there. And at that time, there was an inventory of mines and projects, so actually it created an oversupply in that situation. I think we could be seeing the same type of thing here. We see decarbonization is going to be metals intensive, but we've been burned before, so we're hesitant, we're skeptical about that until it really comes. And when it hits, we're going to be struggling to sort of catch up to it. We won't have the same inventory in place like we would have had back in 2005. And so it will be harder to get that going.
What's going to be happening is that the majors are going to have to bring in the mines that the juniors and the others cannot bring in themselves.
I was reflecting. I was reflecting on the fact I was writing my closing comments at lunch today, but that the quality of the presentations and the pitches were really good today. And 15 years ago, the majors would have been all over these companies, and they're not now. So they're not ready yet, but by necessity, they will have to get ready. It will require patience for that, but I do see this is somewhat of a repeat of what happened 25 years ago.
Yeah, but you can't invest in exploration now if you're not going to be in production for 20 years. You're going to have to invest in something that's got up to about year 18, and then you can bring it in much quicker because you've got the capital. These poor companies with development projects that are waiting for a stockbroker to write them a check are pretty unhappy. And Martino's going to take them over or something like that.
Well, not if we continue to...
They find all their own stuff.
Not if we continue to find them, exactly. But, you know...
Well, you heard from the royalty panel, that's in their feeding ground. Because
the worry is that the royalty companies are going to profit out of this because, I mean, David Harknell sits up here and looks around the room and says, we got $2 billion available. What have you guys got? Which is...
so there is capital out there. It's just not the traditional sources.
No, but the world is changing. And from a value investor's point of view, you've got to be in projects that meet the criteria. You got to have the geology, you got to have the jurisdiction, you got to have management, which is what Mining Journal finds the hardest to assess. How do you evaluate management? And then you got to have the thing that I lack, which is timing. Yeah, you need all of them.
But there are companies. There's one more factor you need is patience, and you got that. So, but you have to be patient.
How much patience, though? Yeah. That's the problem. Because I'm looking at companies that have all the things that you've described, Rod, and they're down 35% from where they were last year.
But you opened with that remark. Can you come up with a conclusion to it?
No, I'm beaten up in a bear market.
Well, then you're going to be taken over at the wrong price.
Well, I leave you a bit more optimist. I mean, you typically see first a re-rate in larger companies, then it goes into mid-tiers, those smaller producers, developers, and eventually the explorers. And on the gold side, from what we've been seeing at Endeavour, over the last few months, it's been refreshing because we have been getting inbounds of generalists that weren't previously looking at the space. And I just want to bounce on Tom's comments. I mean, I think the junior space is doing a great job pitching their stories, better than it used to be. I mean, before it was just cross sections and you didn't know what was happening, especially for someone that's not so familiar with the space. I think where the gap is now is the larger companies are not speaking the same language as the generalist funds. You open up our gold mining presentation today, you're still talking all this gold mining jargon, all in sustaining costs. You're talking sustaining capex, non-sustaining, growth capex. At the end of the day, what's the EBITDA? What's the free cash flow yield? What's the leverage ratio? Give me some real tangible numbers that I can compare to other sectors. Sorry?
He likes dividend yield, yeah.
Yeah.
What I liked in some of the presentations today was that besides just the NPV, which even though it's too low a discount rate, I liked that everyone was using NPV per capital dollar. And I think that's something that you wouldn't have seen a couple of years ago. You wouldn't have seen in the last cycle. And that is reinforcing the fact that the mining companies are actually, the juniors, the developers are more focused on how to bring in capital light development solutions. I saw presentations where, rather than build their own mill, beg, borrow, and steal to use somebody else's mill. These are, I think, the right type of decisions, the right kind of thinking, fit for purpose for this cycle.
See, maybe investors think they're using the wrong metrics because it's not working out for them. Christopher, what have we failed to cover here that really is important? You're a strategist. We're just investors.
I've been I was at a conference in Riyadh in January, and they were talking about how they could evolve a Middle Eastern mining sector. I said, part of the thing is finding the deposits and then working them up in the traditional way that we're used to. But the other half is actually creating an investor base. And I see that we still have an investor base in retail and in Australia and Canada. But in the UK, the retail base has decayed a lot since Big Bang in the 1980s through the annihilation of retail stockbrokers. And we've also seen in the US where, there used to be as many as 5 or 8 companies in the Dow Jones index that used to be mining companies or associated with materials, and they've all disappeared over time. And so basically the US retail investor base has become alienated from investing in mining stocks. And, we can't just rely upon institutions to invest into these things. There needs to be an education process of the retail investors in the UK. I think that we're pushing on an open door there potentially, but we need to find a way to re-engage retail in these 2 large markets, and I would also include continental Europe in that, where virtually no continental investors invest in mining stocks except for the few random, gold bugs in Germany and Switzerland. You're not getting the investors into these big stories, because the more they're invested in them, the more they may push back against the type of OECD and high governmental sort of anti-mining initiatives, because under this Inflation Reduction Act in the US, everyone's saying, oh yeah, it's great, we're going to have all these midstream and downstream industries, but we don't want to have any of the mining. How does that work out? Is the dirty part of the equation going to be in some third world nation? And then you're going to bring the products back and they're going to be refined in the US and turned into EV batteries? No, these countries are now saying, as we've seen in Indonesia, the DRC, various other countries, saying, oh, no, we want the processing here, and we actually want the mega factories, the gigafactories, pardon me, here as well. We don't want them in the US Midwest. And so if the US is not prepared to allow the mining, then it's hopefully not going to end up with the gigafactories either.
I think one of the reasons why we're going to struggle to ignite retail interest in this country in mining generally is that a lot of people who work in mining invest their money in mining because it's an industry they understand. And mining as an industry that people actually operate in here in the UK is, you know, we used to be the mining capital of the world and we used to supply the workforce to all the world's mines. And that still happens in Canada and Australia, but it doesn't happen here.
Well, it's happening with China now, and the
Sure,
world is working for China.
Let me finish. And so the issue is, until we start building and operating and running mines in this country, I think we're going to struggle to create the mindset that also invests in mining. Thank you.
Okay. John, last word?
Yeah, last word. Last word for me. There's one thing that I tried to do post-Brexit. Not Brexit, sorry. When we had the gold mining collapse in the late 90s. It began with a B, but it wasn't Brexit. It was BX. Running a small junior in those days, probably very similar to running a small junior today. And I had the bright idea, which clearly was a waste of time, but that if only 2 or 3 of us got together and put together a portfolio from our good assets, we could look after our shareholders and we could raise funds. But together we would sink. And guess what? No management team wants to share its work with somebody else's, and we all sunk. So I think there's a bit of a message there that maybe we could do more in the junior market if the junior market actually coalesced a little bit and looked after their shareholders. Over.
And I've got one. So at the end of the day, you're positive, and basically the panel all sees the case for investing in resource projects, particularly when they're developed. But we're frustrated that the investor base doesn't. So value investors, take it seriously, look up all of the mining journal stuff, and follow Dominic Frisby, follow Christopher Ecclestone, and follow the majors. That's my advice.
And the miners bring things in on budget and on time. And speaking of time,
you're out of it.
You're out of it. So thank you very much.
Okay.